what is happening in the West in terms of Japan, Korea, Taiwan, and of course US. There are divergent interest rates across these economies. At the same time, we are looking at some of the economies, large economies, slowing down, and of course, in terms of what is happening in terms of the capital flows. Of course, when you look at U.S. yields rising, the capital flows naturally move back to U.S. And I think the AI story also playing simultaneously. Some of the valuation concerns were there in between. I think So how do you assess as far as the your views on the global markets
Yeah.
in respect of
So,
that?
yeah. So US itself tends to dominate on that narrative, Mohit, because US itself is close to about 62-63% of sort of the global market cap itself, right? Now, within the US, as you rightly said, rates have been high, and there's probably likelihood of further rate tightening as well. So in that kind of an environment, obviously the risk-free rate from a dollar perspective also goes up, right? What is more likely to happen, what we anticipate, just given the kind of valuations in the tech sector and the AI, I would say in some senses almost over-investment, there is a very strong likelihood of sector rotation, right? So you will probably see significant money rotating out of maybe some of the AI plays, and we're beginning to see that already. And going more into sort of the more traditional consumption, pharma, defense, those kind of sectors, traditional Main Street kind of sectors, not just Silicon Valley. If I look at other markets like Japan and the fact that the US is intervening to save the yen, right, tells you a very, very big story of how they would like to support the carry trade in yen still, right? So we expect that Japan will significantly benefit as well from this. Markets like Taiwan and Korea have tended to be very, very narrow, right? So it's usually a couple of stocks that really have driven these markets, right? Now they've also been highly leveraged, right, in terms of participation in these markets. So that actually creates much greater risk, right, when you have such a concentrated index and there is leverage going into that. Those markets then tend to they can be very, very volatile, right? And so it's really caveat emptor at that point of time. But that said, I would say the US is really the market that we should really track very closely, just given its preponderance in terms of the weight in the overall index.